I think what's going on in the bond market is doing the tightening for the Fed. I think the scenario that we may find as we move through this quarter is that the narrative of 4 rate hikes, with some people saying, well, that's not that, we're going to see more than that. I think that narrative is going to go away. And the story that's going to fill in this quarter is going to be the tightening's already happened. The Fed's not going to be hiking rates. We're moving to the Fed having to respond to a weak economy because you're starting to see it. And so I think the thing that really drives bull markets, as you know, is not as much strong economy as it is weak economy. It requires certainly in this last decade, it's a weak economy. It requires Fed stimulus.
Hey everybody, this is 𝙈𝙀𝙏 with 𝙂𝙊𝙇𝙍𝙀𝑒. It is Tuesday, January 18th, 2022. I have a very special returning guest to the program, David Hunter, known as the Contrarian Macro Strategist. He's been covering Wall Street for over 40 years, has a massive Twitter following, and a way that you can connect with him as well on his newsletter and his news service. David, how are you doing today?
I'm great, Rob. How are you?
I'm doing very well. We were talking just before the program about COVID. I think I got it last week, potentially for the first time. I'm still waiting on my test results. I wasn't down too much. It was like a really bad cold, as we're talking about. But I guess the good news, I finally did get it. So I get my antibodies up to snuff along with everybody else. But we're looking at lockdowns in China, are reported the last couple of days on Bloomberg. They're locking down 3 cities due to COVID. So potentially some slowdown in the world economy from there. I know you've been predicting that the U.S. markets are continuing to march down a little bit before we get this last melt up. Maybe you can explain what your theory is on that and what we're seeing.
Sure. Yeah, starting back in probably early November, late October, early November, it looked to me like the market was setting up for a correction. And I started talking back then about maybe the NASDAQ having a 10% correction and the S&P and Dow maybe a 5 or 6%, possibly a little more. We did that, as you know, back in November, and then it ran. And I was not real satisfied because there were certain things under the market that I had expected to correct more, and they hadn't, like semiconductors. So I looked and I said, there's a lot of stuff that still looks like it needs work. So, that first bounce was like in, I don't know, I remember 3 or 4 or 5 days, we covered a lot of ground. And I said, that's just too fast. I had a lot of people, because they know my melt up scenario, said, you're missing your own forecast. This thing's off to the races. Here's the melt up. And I don't think so. So it came back down, as you know, in December, pre-Christmas. And then we got the year-end rally. And again, I heard, you're missing your melt up. Here we go. And people jumped on the bandwagon. Everybody's bullish. And, you did have a pretty good move in the end of the year. But still, I didn't see some things there. There were a lot of divergences. And I said, I just don't think it's done. And now here we are again, I think, third time down. I think third time's going to be the charm. I believe, I'm using 4,400 to 4,500 as my S&P target. NASDAQ might drop to 14, which is lower than I originally thought it would go. And the Dow, 34, 35,000. And then I think we are pretty well set up for, this is probably the more controversial now, because people think we've seen the top. But I think in my January letter that came out a couple of weeks ago, I raised my targets. I was already high on the street. I raised my S&P from 5,300 to 6,000. I raised my Dow target from 42 to 45,000, and my NASDAQ from 18 to 20,000, and Russell 2,000 from 2,900 to 3,000. So it looks to me like from these correction lows, you could have a 30 to 40% run in the market. And I think it'll happen in a matter of months. So whether that's 2 months or 4 months, that's kind of my time frame, is that it's end of first quarter or sometime in the second quarter, we get to what I call a 39-year secular top. And then, there's a lot more bad news to follow. But I know that's a stretch. I mean, that's 30 or 40% in a few months' time is pretty unprecedented. But that's what a meltup is. I mean, meltups are not, I think a lot of people throw around the term, but meltups are not just a big rally. They are something that you don't see very often. I say that the meltups I remember or know of are the 29 run, maybe the Nifty 50 run in 73, and the NASDAQ run in 2000. It's not something we see very often. So I use the term stunning. I think it's going to be a stunning rally. We've had a pretty remarkable run from March 2020. This will be the steepest of all the runs and carry, quite a ways.
So what actually causes the melt up? What causes that market to act like that, to really go beyond what you typically see?
I struggled in the last couple months of the year to try to, because it was things where I was looking for Fed tightening to end the cycle, and obviously we're getting that rhetoric. We're certainly seeing in the last 2 or 3 months, and particularly the last couple of months, that the Fed is being forced to move to tightening, and now the expectation on the street is for 4 rate hikes in 2022. So I was struggling because I'm going, that's, how do we get this kind of run in that kind of environment? I think you're seeing just now the evidence in the economy that, and I have been saying this for a few weeks, but I think what's going on in the bond market is doing the tightening for the Fed. I think the scenario that we may find as we move through this quarter is that the narrative of 4 rate hikes, with some people saying, well, that's not that, we're going to see more than that. I think that narrative is going to go away. And the story that's going to fill in this quarter is going to be the tightening's already happened. The Fed's not going to be hiking rates. We're moving to the Fed having to respond to a weak economy because you're starting to see it. And so I think the thing that really drives bull markets, as you know, is not as much strong economy as it is weak economy. It requires, certainly in this last decade, it's a weak economy that requires Fed stimulus. So I think we may, ironically, with everybody getting more bearish about what the Fed's going to have to do, we may be on the verge of that shifting. And I'm not saying it's going to shift in the January meeting next week, but I think as we move through the quarter, I think that's going to become, the street will probably recognize it before the Fed does. So I think that's going to be the shift in the narrative that drives the market. And if people can get convinced that the excesses have been wound out by a move in the bond market, the 10-year moving from 135 to say 2.25 in a matter of weeks or months, couple months, if they can be convinced that that did the job, imagine what that does to bullishness. I mean, I think people get on, because then they can buy growth stocks, they can buy cyclical stocks, they can, I think you'll have and I've been saying this will be this meltup will be a broad rally. It won't be, a handful of stocks driving the market.
Is the meltup basically equivalent to people having that last big hurrah? I mean, people, I think, kind of know there are problems underlying the economy, but they don't necessarily want that to enter their psyche or their consciousness. They're kind of holding it back. And so a lot of times when things are bad, people will throw that one, big last party, get drunk, those types of things. Is that essentially what the meltup is? It's that one last party in the economy?
Yeah, I think the reality is that's what it will be. I think at the top, though, the narrative is going to be this thing has legs and it can run for a couple of years. So the reality will be that this is the last hurrah. That's why I don't think it lasts more than a handful of months. But I think, as you know, at tops, everybody's all in, and they have, they're not buying just because the market's going up. They're buying because they really believe, we now have a long runway ahead in terms of, bullishness and reasons to be bullish. So, you got to kind of separate out what I think it will be versus what I think the investor is going to think it is.
Yeah. And I would say some of the bond investors are some of the smarter investors in the world, certainly more than stock investors. The bond market always seems to react ahead of time, and at least in predicting what's going to happen. We've had some rising pressure on rates in the bonds. Talk about the bond market right now. What is that telling you is happening?
Yeah, it's interesting. I've used a term that I probably haven't used in 40 years, many times in the last month or two, bond vigilante. And the bond vigilantes are doing the Fed's job for them. You know, the yield curve is tightening. You know, we're moving towards an inverted yield curve. Spreads are just beginning to widen, but they're starting. And I think that is I've had a 2.5 to 260 type of target for the 10-year in this tightening phase. I think we're probably, and recently I've been saying we're probably headed for, 210, 215 short term. Then we might go, sideways for weeks and consolidate, or we could just push right on to 2.5. It's hard to know. But I do think that people are looking at this as a beginning of a tightening cycle, when I think it's really closer to the end of a tightening cycle, and which is ironic because it hasn't been very long. But that's the nature of what I think the bond market has to get their arms around, which is there's a lot of fragility in this system. So it doesn't take a normal tightening cycle to, cause problems. What's going to make it hard for the Fed, and we'll just have to wait and see how they handle it down the road, is I'm not sure inflation's gonna be in the same place that the economy is. I think the economy can look weak because of supply chain issues. What you just mentioned about China is going to probably make it worse. And so weakening economy can be one thing, but the inflation has, I think, wind at its back. So you may have, stagflation is going to be a word you're going to hear more of, I think. So that makes it hard for the Fed to choose, which do we fight? Do we fight the economy getting weaker and try to combat against that? Or do we fight the inflation that seems to be roaring away? And I have targets of $6 on copper, and lumber looks like it's heading back to the highs, which was 1,700, back in 2020. If those are correct calls, they're going to exacerbate inflation. In other words, commodities look like they have wind at their back, and I think they do for another several months. So the Fed's going to be in a tight spot trying to figure out which. But I don't think I think Jerome Powell learned a very important lesson back in December of 2018. If you remember.
Yeah, the 20% stock market correction after the Fed had raised rates, right?
Yeah, and he turned on a dime. I mean, he was, Christmas Eve, he was bearish. Christmas, by early January, his narrative had completely changed. So it doesn't take long for him. I think he's a pretty quick learner. And I think that lesson is still in his brain, that if he sees the economy starting to weaken, I don't think he's going to stick by, hey, I've got to, we've got to stay the course. I think he's nervously where he is anyway. He called inflation transitory until, all of a sudden the jobs number in December was, skyrocketing. And I think that just forced them at that meeting to say, hey, we can't, we're looking like fools if we keep, talking about transitory. So if he can reverse just as quickly back the other way, I think.
Yeah, let's talk about the weakness in the economy. Today, the Empire State Manufacturing Index came out. It was a negative number, which I think is shocking economists. Last month, they had a 32 print on the scale. They were expecting a 25.5, and it came out negative 0.7. So U.S. manufacturing is turning down. I've documented how Q3 and Q4 consumer sales, when adjusted for inflation, were basically flatline year over year. So 2021, the last half of the year, we didn't get the big consumer push. Then news came out that consumers are maxing out their credit cards again, which indicates that they lack savings. And then, of course, you got the inflation argument. You got all these things saying that the economy, at least the broad economy, looks like maybe it's rolling over. Is that your view here? Do you think it's temporary weakness, or do you think it's something more sustainable?
Yeah, I think it may be more sustainable. I've said the pandemic makes it a tough job for economists, because I think there's a lot of fragility below the surface. Statistically, fourth quarter was, supposed to be a gangbusters quarter, and statistically, it's still better than third quarter. But below the surface, there's just still so much fragility. The fact that there's, maybe the jobs number looks strong, but I know there's statistics out there showing there's a 25% unemployment rate out there. I mean, there just depends on how you count the numbers. Certainly landlords, there's got to be a lot of landlords that haven't seen rent payments because of moratoriums, et cetera. And I'm sure banks are being told they can't foreclose on homes, et cetera. So I just think there's a lot that can fall apart in a hurry. And then, as you say, we thought some numbers point to consumers having plenty of savings, that it moved up, but then you get other evidence that says no, they're, and also the fact that a lot of them have chosen to stay home until they drain that savings. I mean, it's just a funny place we're in, where I don't think you can have a lot of confidence in this economy. So I'm not sure what the statistics are going to show as we move through the first half, but I'm not saying we're going into recession here, but I think it's going to soften enough that it's going to spook the Fed.
All right, I want to talk about precious metals for a moment, because I know large part of my following gold, silver pros do follow the precious metals. You've been saying over Twitter that you're expecting new highs for gold and for silver to be very strong first half. Just walk us through your argument for that.
Sure. Yeah, I'll take a big step back to what we saw in the first part of this century. The 2001 to 2011 run was amazing. Gold went from 250 to 1900 plus. And then you had that long consolidation started coming out of it in 2016, I think. And it's been kind of an up and down type of move since. There's a definite flag formation if you look at it technically and you step back from a shorter term chart to a much longer chart. It's a very bullish picture. The amazing thing is, I think, that we've gone sideways for 16 months in the kind of environment we've had. You would have thought inflation's obviously broken out from 40 years of disinflation. You've had, but the dollar was strong. So I plead guilty to expecting gold to, had a great run out of the 2020 swoon, ran to August, and I thought, yeah, you'll have a few months of consolidating that gain, and then it'll be off to the races. Well, we're now 16 months into that consolidation, and people are very impatient, or rightfully impatient, I should say, wondering if it's ever going to happen. That's the kind of sentiment that I think bottoms are made of. You are seeing signs that I think the dollar is beginning to top out and roll over. It's been strong today, but I don't think this is going to have legs. And if the dollar rolls over, inflation continues to go higher, and particularly if we can get that other the headwind out of the way, which is higher interest rates. Even though real rates are negative, that higher nominal rate has been really getting in the way of gold, I think, and silver. If we can get to that point where the Fed says, or people realize Fed's likely not going to be hiking rates 3 or 4 times this year, I think that is the real trigger that will drive the move. I think the move starts before that, but I think that could take you to my targets, which is gold 2,500, silver 50, and I think you can get there, by mid-year.
So David, you mentioned earlier you expect copper maybe will hit $6, which would be huge for the economy, given how much copper we use and how dependent everybody is on it. What's your view of the miners because of these commodity prices? You think they're going to do well for 2022?
Yeah, I think you'll see easily, and certainly in some of the ETFs, I have targets that are more than doubles from where they are. And in silver, probably a 2.5 times, 3 times type move. So yeah, I think the miners do very well, as they typically do. If the metals do well, the miners usually outperform that by quite a bit.
So what do you expect to see for the rest of 2022? Just get your view on anything else that you want to share with viewers.
Sure, that's the one side of the coin. I kind of call this as 2022 tale of two cities. The first half, you can have that, what I call a stunning run in the stock market. I mean, truly stunning in terms of the kind of ground it will cover in a short time. The other half of the year, though, I think we're going to begin dealing with ultimately a global bust. I don't know when it starts, whether it's third quarter, fourth quarter, or stretches, but I do think that that's the risk, is that this is the end of the cycle. Again, the narrative that's going to push the stock market is not going to be talking about an end of cycle. It's going to look like it has time to run for a couple of years at least, that the imbalances aren't that bad, et cetera. But I think we'll see that the Fed may not be up to the task, and I'm not blaming anybody. I think there's just too many cross currents, and somewhere in there, they're just not going to see the trouble soon enough to stop it. And I think the second half of the year, we get an 80% bear market combined with a global bust that, again, it's not over this year. It carries into 2023, probably into the middle of 2023. So I think the real message is enjoy it while it lasts, because what comes after that, I think, is going to be pretty historic.
So David, how do people go ahead?
Yeah, let me just finish out the global bust. This is, as I say, global. I think it's going to be accompanied by a financial crisis, the likes of which we have never seen, because there are, not so much U.S. banks, because our banks are pretty well capitalized this time, relative certainly to 2008-9, but the European banks are very vulnerable. The Canadian banks are where we were back in 2008-9, I believe, in terms of overextended. The Australian banks, the Asian banks. So I think you're going to see some major bank failures in that global bust, and maybe many. And if I'm right about that, I think the central bankers around the world are going to be deer in headlights, trying to figure out, what do we do? This thing is just coming apart at the seams. The only tool that they have at their disposal that can move fast enough to stem something like that, along with moratoriums, is just massive money. So there is a recovery cycle after this bust. This is not, end of world type of, collapse. This is really saying in a, fairly short window of maybe a year, you could see the biggest downturn we've seen since the Great Depression. But it will, on the other side of that, lead to what I call an inflation-led, industrial-led recovery cycle around the world.
Very good, David. So how do people get in touch with you if they're interested in your newsletter? And you mentioned it earlier during the January one. How can they reach out to you?
Sure. I'm on Twitter every day. So if they go to Dave H. Contrarian, they can reach me on Twitter. If they're interested in the quarterly letter, just direct message me on Twitter, and I'll provide them details.
Awesome. Thank you so much, David, Contrarian Macro Investor, coming back on the program. Appreciate your perspective.
Okay, thanks, Rob. You take care.
You too. Hey, everybody, this is Robert. Thank you so much for watching that video content. I have a couple of quick announcements I'd like to share with you as we head out of this video. First, I want you to know that on January 26, 2022, we're going to have our inaugural 2022 Metals Kickoff Conference. It'll be the first virtual conference of the year. We'll have many to follow. You can register for it by clicking on the link in the video description below, and which will take you to this page, and you can click to register for that event. We'll have many great speakers there that you guys love. Tavi Costa from Prescott Capital, James Anderson from SD Bullion, John Fennick, Fennick Consulting, Dave Kranzler, Investment Research Dynamics, Andy Schechtman from Miles Franklin, Ian Everard from Mark Silver, and more will be joining us, as well as a slew of companies if you're interested in investing. Also wanted to remind you, you can find us on goldsilverpros.com. We have a free newsletter. If you click here and enter your email address, we'll send that out every Monday to you, as well as we have special precious metals deals with leading bullion dealers here in the United States. If you click that button, you can go here and click on either Miles Franklin or ARC Silver and get the best deals in the business. Once again, thank you guys so much for joining us on the channel. Until next time, this has been Gold Silver Pros.